Thank you very much for joining me on this very cloudy day in Johannesburg. My name is Denisha and I will be covering the January market and portfolio performance and then discussing the ESG investing and how we at Sygnia incorporate this into our investment process, philosophy, as well as investment styles to include the criteria in our portfolios. Please make use of the chat box at the bottom of your screen to post any comments or questions that may arise as we go through the presentation, and we can then address them at the end. I apologize, I'm just having a bit of a technical glitch, so let me try restarting the presentation. So focusing on your investment offering as a Sygnia Umbrella Retirement Fund investor, you would be invested in one of the default life stage strategies. This was decided upon by the management committee of your particular employer, and then as a member, you also have the option of using the member investment choice portfolios. The three options that underpin the investment philosophies are the passive range, the passive active range, or the active balanced range. Within the Sygnia signature range, the underlying investments are allocated to a number of specialist asset managers, both active and passive, that are appointed and selected by Sygnia based predominantly on their skills, their experience, their performance, and their operational and financial soundness. The aim of the signature product is to offer investors access to a well-diversified global balanced portfolio that utilizes the best asset managers in their fields, while also ensuring that the risk profile of the strategy remains consistent over time. Within the skeleton range, this is a multi-asset global balanced product that is managed predominantly on a passive basis. The underlying investments are spread across a number of specialist index tracking portfolios. Sygnia retains the responsibility for managing the asset allocation strategy on an active basis. The aim of the skeleton product is to offer investors access to a well-diversified global balanced portfolio at the lowest possible cost, while also ensuring that the risk profile of the strategy remains consistent over time. Within the active balance mandate, you could make use of the synergy range, which is once again a multi-asset class global balanced portfolio. The underlying investments within the synergy range are allocated to a number of specialist asset managers, which Sygnia appoint and select, once again based on their skills, their experience, their performance, and their operational and financial soundness. The aim of the Synergy Fund is to offer investors access to a well-diversified global balanced portfolio that utilizes the best asset managers in their fields, while ensuring that the risk profile of the strategy remains consistent over time. Members can then opt out of the default life stage strategy and make use of the member individual choice portfolios, which you see currently on screen. They range across the risk spectrum and include the likes of Allan Gray, Coronation, 91, as well as our Sharia compliant portfolio, which is the Islamic balanced high risk portfolio. Taking a look at investment performance, the new year started with quite a significant improvement in sentiment as the COVID-19 vaccines started to roll out worldwide. By the 25th of January, we saw more than 65 million doses having been administered in 56 different countries. The inauguration of the 46th president of the USA was also quite significant for markets, signaling the end of Donald Trump's legacy and his departure from the White House. The Democrats also won control of the Senate, delivering a blue wave across the White House and both houses of Congress for the first time in 10 years. The USA celebrated Joe Biden's win at the Georgia runoff elections. Christmas Eve also brought about the much anticipated conclusion of the Brexit deal, causing the pound to rally and also allowing volatility to ease slightly in that region. We saw an emerging market recovery being driven by a manufacturing rebound as a consequence of the largest global fiscal support seen in the past 2 decades, a weaker dollar, lower US interest rates set to continue for the next 2 to 3 years, as well as stronger global trade policies expected out of the US now that Joe Biden is the new president. In South Africa, our third quarter GDP beat expectations, falling only 6.6% year on year, and we saw that our finance minister, Tito Mboweni, call to cut the 2020 public wages was backed by the Labour Court. This saved the fiscus 38 billion rand, indicating a step in the right direction for South Africa being able to reduce its large debt pile. Taking a look at market performance to the end of January, you'll see over 1 year, the all-share index delivered 14.5%, and the Swix and Cap Swix delivered 9.7 and 6.4% respectively. Resources delivered close to 32% and industrials 21%. These double-digit returns in the South African market were boosted by gains in the mining and retail industry, while investors appeared somewhat undeterred by the recurring power cuts in South Africa, as well as uncertainty around the initial rollout of the COVID-19 vaccine program. Financials and property continue to struggle, mostly on concerns because of a domestic slowdown in growth, property particularly because of supply issues, but banks also because of less growth, fewer loans, and lower interest rates. Domestic bonds and cash delivered 8.2% and 5.1% respectively. We have started to see a turn in the local market cycle for the start of the new year, with the growth asset classes equity now outperforming the defensive asset classes cash and bonds. Very different to what we saw across most of last year when the defensive asset classes were outperforming the growth allocations. January also saw emerging markets doing much better. They performed better than the S&P 500 for the first time in 5 years. That was something quite remarkable. And then offshore equity markets also delivered double-digit returns when reported in rand terms, predominantly because of gains in the healthcare and the technology sectors. As a retirement fund investor, Regulation 28 of the Pension Funds Act allows for a 30% offshore limit to the various asset classes, and the Sygnia portfolios were close to this threshold towards the end of last year and for most of January, which has contributed quite significantly to the outstanding performance of our portfolios. The rand itself wasn't too much of a poor performer, only 5% weaker for the end of last year. Quite amazingly, the rand finished at 14 rand 69 cents to the US dollar for 2020 and then started at 14 rand at the beginning of this year, so quite positive returns to the markets. Now stepping onto your fund-specific performance to the end of January over 1 year, all of the high equity portfolios delivered double-digit returns for both 1 year and 3 months. Over 1 year, both the Signature and Skeleton 70 funds delivered a return in excess of 12%, with the Sygnia Synergy 70 fund having delivered 11.5%. The rest of the portfolios from medium to low equity delivered returns ahead of their respective benchmarks for the respective timeframes. The Signature and Skeleton 50 and 40 funds comfortably delivered returns more than 10% over the 1 year period to the end of January. The Sygnia range of portfolios continued to perform well in this low growth, high volatility environment. Our performance remains stable across the funds from low equity to high equity, and we continue to deliver top performance as far as the peer relative surveys go. Taking a look at the peer relative performance to the end of January, you can see depicted in the variations of red lines, the Signature 70, Synergy, and Skeleton range having outperformed the global large manager watch median. Remember, this is the average return of all of the managers that have qualified for the survey to the end of January. Some of the managers that feature to the end of January include Allen Gray, 91, Coronation, Ford, Old Mutual, Prudential, and Stanlib, to name a few. If we now consider the fund-specific performance that stack up over the shorter term period as well as the longer term horizon, starting with the low equity multi-manager survey, you'll see the featuring of the 40 range, Skeleton 60, Skeleton 40, Signature 40, as well as Synergy 40, sitting within the first, second, and sixth place over 1 year. Over 3 years and 5 years, our funds have also delivered returns in the top 6 positions. The longer term track record for 7 and 10 years, the 40 range has been able to deliver returns within the top 3 positions. Over 10 years, you won't see a Synergy 40 track record because the fund hasn't been around for that long. However, the Signature 40 and the Skeleton 40 fund were the top performers, having delivered double-digit returns, outperforming most of the peers. What's also interesting to note is over the 10-year track record, we do see a fewer managers featuring there, and that's also due to the fact that not all of the funds that have qualified for the survey do in fact have such a long-term track record. Now looking at the low medium equity multi-manager survey, this is where the 50 range features. So over 1 year, Skeleton has taken the first place with 11.5%, Signature 50 with 10.9%, and then Synergy 50 in third place with 9%. Over 3 years, our funds have taken the top 3 positions, and over 5 years, we've taken the top 4 positions. For 7 and 10 years, the Signature 50 range funds are ahead of peers in the industry. Once again, for 10 years, you can see those double-digit returns coming through for Signature 50 at 11.5%, and then for Skeleton 50 at 11%. Now moving on to the medium equity multi-manager range. Over 1 year, the 60 funds have taken the first, second, and third place, having delivered double-digit returns for Signature and Skeleton. Synergy just behind that at 9.9%. Over 3 years and 5 years, we are also in the top 3 positions compared to the peers out there. And then over 7 and 10 years, once again, leading the pack. The high equity multi-manager survey, this is where the 70 range features. Over 1 year, those double-digit returns featuring Skeleton 70 at 12.6, Signature 70 just behind that at 12.4%, and then Synergy 70 at 11.5%. Over 3 years and 5 years, once again, our funds are sitting in the top 3 positions as well as in the top 6 positions. For the longer term track record, the Synergy, Skeleton, and Signature 70 funds have outperformed, having taken the top 3 positions. And then for 10 years, Signature 70 delivered 12.1%, Signature range had outperformed all of the other multi-managers out there, and then Skeleton 70, 11.7%. Very interesting to note because remember, Skeleton is the passively managed fund, whereas the Alexander Forbes Investment Performer is an active, balanced, multi-managed fund. The same is true for the Signature 70 range. So even though we track passive indices across the investment universe, you can see that our funds are also delivering top quartile performance. Now comparing how our funds have featured against some of the single managers, you'll see over 1 year we are sitting in the top 6 positions, over 3 years the top 5 positions, and then over 5 years also within the top 5 positions. Over 1 year it's Coronation and Ford that have been able to outperform the Skeleton and Signature range, and then over 3 years we're getting quite close to the 8% return for Coronation. Over 5 years the Synergy 70 fund was just behind Coronation, having delivered 8.6% behind Coronation's 9.2%. Our Signature 70 and Skeleton fund delivered 7.5% over 5 years, still illustrating this long-term track record with stable performance through different market cycles. Over 7 and 10 years, you see our Sygnia fund starting to feature in the first place. And over 10 years, Signature 70 delivered 12.1%, Skeleton 70 delivered 11.7%. So once again, just a reminder that that long-term track record is quite important because of the fact that you as a long-term retirement fund saver needs to focus on the longer-term strategy and not necessarily just the shorter-term 1 month, 3 month, or 1 year numbers. In terms of the risk-return scatter plot to the end of January, we remain quite confident that our portfolios continue to deliver the optimal level of return for the risk assumed. You can see the Sygnia portfolio ranges depicted at the top of the screen in the various blocks, and we believe that our portfolios continue to deliver an optimal level of return for the level of risk that we have assumed. The only portfolio that has outperformed us to the end of January is 91. You can see that the Signature 70 performance has actually outperformed compared to the level of risk, and then quite close to 91's performance is then the medium equity portfolios and the more conservative type portfolios. If we look at the portfolio positioning to the end of January, you do know that the Signature and Skeleton ranges make use of a tactical asset allocation overlay as a risk mitigation tool. Considering the strategic asset allocation of the 70 range to the end of January, you can see that for South African equity, we are currently slightly underweight, South African bonds currently overweight. Our biggest underweight positions are within the South African income and money market space. This is because of the fact that we saw the South African Reserve Bank cutting interest rates quite dramatically over last year as a fiscal response measure to the COVID-19 pandemic. We still have no exposure to international bonds because of the low global interest rates that are expected to continue for the foreseeable future, as well as the large amount of quantitative easing across the globe. The largest overweight on the portfolios are currently within global equity, thus speaking to our additional allocation to those offshore allocations that are doing predominantly well in the healthcare and the technology sector. Let's now step on to the discussion around what is ESG investing. As investors, many of us are not just interested in the financial outcomes, but also in the impact of our investments as a role that we can play in promoting global issues such as climate action. Sustainable investing includes impact investing, socially responsible investing, as well as ESG investing. ESG stands for environmental, social, and governance investing. This talks about the umbrella term for investments that seek positive returns and a constructive long-term impact on society, as well as considering our impact on the environment over and above the performance of the business. Investors are increasingly applying these non-financial ESG factors such as climate change, resource depletion, waste, pollution, bribery and corruption, executive pay, to name a few, as part of their non-financial factors when considering the analysis process to identify material risks and growth opportunities in investments. One demographic that is particularly interested in ESG investing are the millennials. According to recent studies, millennials are more likely to trust a company or purchase a company's products when the company has a reputation of being socially and environmentally responsible. Research has suggested that investors are asking more questions of their wealth managers and scrutinizing their investments to understand what they own and how it impacts society and the planet at large. According to the recent studies, millennials are more likely to turn down a product or a service from a company if it is perceived to be socially or environmentally irresponsible. Almost 87% of high net worth millennials considered a company's ESG track record an important consideration in their decision about whether or not to invest with that company, and almost 90% of millennials want to tailor their investment strategy to reflect their personal values. This just indicates the importance of the desire for money to not just earn a return, but also to align with the personal values and contribute to the social good. As a long-term investor, and considering that most of Sygnia's clients hold similar long-term views, we believe that incorporating environmental, social, and governance factors into our investment process at Sygnia is sensible and constructive, and will ultimately contribute to the superior long-term investment performance as well as to mitigating risk. When it comes to responsible investing and sustainable investment practices, Sygnia is guided by the compliance with the principles embodied in Regulation 28 of the Pension Funds Act, the CRISA principles, the United Nations Principles of Responsible Investment, Guidance Note 1 of 2019, as well as the Responsible Investment and Ownership Guide for Pension Funds and South Africa. At Sygnia, we continue to advocate sustainable investing with a focus on governance in our portfolios. We utilize a multi-pronged approach that is dependent on the asset class. Some examples of ESG issues are climate change, waste, pollution, human rights, employee relations, executive pay, and tax strategies. The examples of responsible investment strategies that we consider when making decisions are integration, which explicitly and systematically includes ESG issues in investment analysis and decisions, a thematic theme which targets a specific environmental or social outcome. Exclusions or screening implies that we would apply filters to a list of potential investments. Positive tilt looks towards sectors or companies and projects with a positive ESG characteristic, and then it excludes certain companies based on ESG criteria. Best in class invests only in companies that lead their peer groups in ESG performance, and impact investing considers investments with the primary goal of achieving specific positive environmental and social benefits while also delivering a phenomenal financial return. With the use of engagement and proxy voting, companies are encouraged to improve their ESG risk management or overall sustainability of their business practices as the shareholder or owner of the company. Engagement means discussing ESG issues with companies to improve their handling, including disclosure of such issues, and proxy voting implies that you will formally express your approval or disapproval by voting on resolutions and proposing shareholder resolutions on specific ESG factors. Over time, the number of ESG regulations have increased. Taking a look at this graph, the cultural shift is clear. Investors are starting to ask more and more of companies. In terms of policy and regulation, governments worldwide are increasingly focused on sustainability. Currently, South Africa is the second country to formally encourage institutional investors to incorporate ESG factors into their investment decisions. As a whole, society has started attributing increased levels of importance to sustainable finance and to ESG factors. COVID-19 has accelerated this shift, bringing the real-life impacts of overlooking ESG factors into the spotlight. In terms of risk mitigation and performance, ESG inclusions tend to be more resilient in times of crisis and also provide a momentum effect because the increased interest in sustainability will drive up the demand and prices of those shares that are particularly in adherence to the ESG factors. Within the South African ESG landscape, there is a growing awareness of consumption behavior and the environment and society at large. We are also starting to see ESG specific voting at shareholder meetings. Infrastructure investment is set to be a key theme in South Africa's sustainable investing landscape. Environmental focus areas include the likes of renewable energy, water, sanitization, and transport, and social focus areas include job creation and skills development, small and medium enterprise development, as well as Black economic empowerment, financial inclusion, and access to quality education and healthcare. The South African government is prioritizing infrastructure spend to drive economic growth. With this drive, there are ongoing industry discussions to establish the avenues available for investors to fund these infrastructure projects. Sygnia continues to be a part of these discussions. The infrastructure space promises to be an exciting growth story for South Africa should the implementation and delivery on the public side prove robust. As it stands, we are still awaiting the updates to Regulation 28, which must still clearly define what constitutes infrastructure. Currently, Sygnia invests in road, grid, development, and water infrastructure, which are the avenues that are now available for the asset management industry as far as infrastructure goes. The infrastructure renewable projects that are anticipated will be extremely vital for South Africans' growth. Our Sygnia funds already support infrastructure through our credit portfolios, which have exposure to state-owned entities with specific investments in energy, road, water, rail, sanitization, and job creation. As can be seen in this chart, state-owned entity spreads have widened considerably and offer value despite the risk. The next phase of government's infrastructure plan is a series of project-level infrastructure investments that will be packaged through the Development Bank of South Africa. We are well positioned to invest in these projects for our funds across the debt spectrum. However, it is still early days and we await the details of these infrastructure projects. The 5 core principles embedded in the Code for Responsible Investing are the incorporation of sustainability considerations, including environmental, social, and governance, into an institutional investor's investment analysis and activities, the demonstration of an institutional investor's acceptance and ownership responsibilities, the use of a collaborative approach to promote acceptance and implementation of the principles of CRISA, as well as other codes and standards applicable to institutional investors, the proactive management of conflicts of interest, and transparency around the content of those policies. In our role as multi-manager, we at Sygnia apply the principles of responsible investment and active ownership by ensuring that the underlying asset managers in our portfolios have a documented ESG policy in place, and then by monitoring the implementation of that policy. Active managers in the Sygnia stable have a large research team and robust processes in place to ensure ownership responsibilities and appropriate engagement. Where Sygnia acts as a passive manager, the choice of investments are dictated by the components of the underlying predetermined market indices. As we are largely required to hold all of the components of the relevant indices, we are constrained in our ability to avoid investing in companies on the basis of their ESG performance. Instead, we apply reasonable ownership in the form of active ownership by making use of proxy voting. This is done through collaboration with selective active managers in our multi-manager portfolios. We then apply active ownership principles to the local indices that we track. The active managers are required to submit their votes and supporting research to Sygnia ahead of every shareholder vote, and the Sygnia Investment Committee will then review the research and voting recommendation and then decide independently on how to vote for a particular share. We do feel that this is an excellent way for passive managers to exercise their governance responsibility in the underlying investments. Within our credit portfolios, we increasingly include environmental, social, and governance issues in our credit review process, and we actively engage with key industry players around social, green, and transition bonds to increase the supply of assets focused on sustainability. We also support trustees in their investment policy statement with regards to Board Notice 1 of 2019. Internally, within the Sygnia multi-managed portfolios, which include our passive funds, the credit portfolio, impact investing, as well as the money market S-class funds, we make use of passive proxy voting, and ESG is incorporated into the credit process. All fees from these funds are donated to charity. For the external active managers, we consider their stewardship reports as well as their reporting on ESG and their proxy voting reports. As far as the details that are required by the guidance note goes, the two focus areas are to ensure that a fund's investment policy statement contains reference to sustainable investing and to ensure appropriate disclosure and reporting. The investment policy statement should reflect how the investment philosophy and objectives of the fund seek to ensure the sustainability of its assets. Every fund is encouraged to make use of its investment policy statement and to make it available on request on the website, encouraging members and shareholders to be aware of any changes that are made. The Financial Services Conduct Authority encourages this transparent fund disclosure as far as all matters related to sustainability goes. If we now take a look at our individual ESG managers that we make use of within our multi-managed portfolios, starting with Coronation. Coronation makes use of sustainability issues as part of their fundamental analysis. They prefer active engagement rather than exclusion. They could possibly exclude companies based on involvement in cluster or anti-personal minds. They make use of a 5-step level of engagement, starting with team engagement, escalating issues to the board where appropriate, engaging with fellow shareholders, taking appropriate steps at the AGM, or perhaps calling a special purpose meeting if required. As a last resort, they will approach the media. If none of these steps affect change, they will then reassess the investment case and the valuation models and then take the appropriate action within the portfolios. 91, which is the new name for Investec asset managers, include ESG factors in their investment strategy. Engagement with companies and government is key to addressing their sustainability and improving their ESG performance. Senior executives serve on the Investment Governance Committee, and all of the investment processes integrate material ESG factors and identify engagement opportunities based on investment priorities. This diagram illustrates the composition of their boards, including the Sustainability, Social, and Ethics Committee, and as you can see that they all report into the CEO and their co-chief investment officers form part of the investment teams as well as the ESG teams. ABACs make use of investments in businesses that exhibit robust corporate governance, quality management, sustainable business models, and the potential for solid growth in earnings and dividends over an extended period. They use a priority scorecard approach which focuses on trend rather than absolute score. They ensure consistent engagement with management on material ESG issues. They also make use of all proxy voting for resolutions at shareholder meetings when they act on behalf of Sygnia clients. Now taking a look at our ESG products spotlight, starting with the Oxford Sciences and Innovation Fund. This fund is all about investing for impact. Oxford Sciences Innovation plc was a global impact fund that is registered by the University of Oxford in 2015 to try and help academics and the university commercialize the intellectual property generated within the Oxford ecosystem. OSI effectively owns the rights to approximately 25% of all patents that are produced by the university and currently has a portfolio of investments in around 79 spin-out companies. The company aims to spin out close to 10 or 15 new companies each year. The Sygnia OSI Fund has a significant stake in OSI, providing South African investors with a unique opportunity to do good in the world while also gaining access to an exciting global investment opportunity. The OSI mission states, "We have a single purpose: to help Oxford's outstanding scientists build and grow great businesses that can improve the world." The OSI companies are all involved in fusing technology and artificial intelligence with biosciences and focus on, amongst other fields, healthcare provision and clean energy generation. In addition, the spin-off companies are early-stage job creators rather than large multinationals. Oxford is the oldest and top research university in the world and has had more spin-offs in the past 5 years than ever before. We believe that the OSI investment is a perfect solution for our clients, given the regulatory focus on ESG and impact investing and the increasing pressure from our investors for an ESG solution within our portfolios. The Sygnia Health Innovation Global Equity Fund was launched with the aim of investing in opportunities to reinvent healthcare provision and improve the quality of life for all. The fund invests primarily in listed global companies in the healthcare sector, but also has a mandate to expand its investments to groundbreaking research and developments in life sciences. The fund involves making use of breakthrough technologies in biotechnology, nanotechnology, information technology, genetic engineering, robotics, and 3D printing technologies. The healthcare sector is poised for continued growth, innovation, and expansion, but it is also vital to the achievement of ensuring healthy lives and promoting well-being for all. In addition, the fund has also incorporated an ESG screen in its investment process to ensure that all of the portfolio companies meet Sygnia's minimum ESG reporting requirements. Taking a look at our ESG screening methodology, we are predominantly informed by the Refinitiv ESG score grade system. We also verify and validate the results with ESG scoring systems from Sustain Analytics and RobecoSAM. Refinitiv scores are comprehensive and use data-driven methodology. It encourages ESG reporting transparency where companies are penalized for poor disclosure and includes a controversies overlay. The outcome is comparable between industry peers because of the percentile-based scoring system used. The materiality of the ESG factors are adjusted by the industry, and the ESG score is refreshed weekly because of company updates, new companies entering the scoring system, or perhaps controversies encountered by the companies that are included in the system. This diagram provides a summary of the Refinitiv ESG scoring system and the key pillars on which each company is measured. Once again, the environmental, social, and governance pillars are quite important. The combined ESG score will then be calculated by discounting the ESG score by the extent of a company's involvement in ESG controversies. The metrics that are produced by the system include more than 450 various data points, ratios, and analytics that we can make use of when deciding whether or not a company does in fact meet our minimum ESG criteria. Within the Sygnia income portfolios, as at the end of October of last year, approximately 16% of the Sygnia Enhanced Income Fund was invested in solutions for affordable housing, affordable healthcare, green bonds, and access to finance. Approximately 6.3% of the Sygnia core income portfolio was invested in green bonds. These portfolios invest in infrastructure, making use of the avenues that are currently available to the asset management industry. The likes of state-owned entity spends on infrastructure projects, including SANRAL for road infrastructure, Eskom for grid infrastructure, the Development Bank of South Africa for development infrastructure, Rand Water for water infrastructure. Now taking a look at what is to come. We will soon be launching the Sygnia Itrix S&P Global 1200 ESG Exchange Traded Fund. This fund aims to provide investors with efficient exposure to the global equity market by tracking the S&P Global 1200 index. The S&P Global 1200 index currently captures 70% of the global stock market capitalization, covering 7 distinct regions and 30 countries. These include exposure to the US, Europe, Japan, Canada, Australia, Asia, and Latin America. The fund will provide the investor with diversification both from a currency as well as a geographic perspective. This will also have an impact on both risk and return. The S&P Global 1200 Index has a large interest in developed markets, which are currently experiencing reasonable economic growth and boasts exposure to some of the largest and well-respected companies globally. Specific ESG exclusion criteria apply, which avoids investments in the likes of tobacco, thermal coal, controversial weapons, and those companies that depict a poor ESG score. As far as the top 10 constituents by index weight goes, some well-known names including Apple, Microsoft, Amazon, and Nestle. The fund will invest across various sectors, including the likes of information technology, consumer discretionary stocks, communication services, as well as consumer staples. So we are quite excited about this, and we expect to have this fund ready for you within the next few months. There's absolutely no doubt that ESG and sustainability considerations are one of the most important investment considerations for the coming years, and we at Sygnia continue to remain committed to supporting trustees and investors in the pursuit of and adherence to these goals. We will constantly aim to provide our investors with transparency and accountability in all ESG reporting. Let's now take a look at some of the questions that may have come through. So we've got a question on when will the ESG ETF be launched. We are expecting that by the end of June, the portfolio will be ready for investors. And then what are the upcoming risk considerations that the investment team is focused on? So definitely the budget speech, which we anticipate. So we await the outcome of that. We are hoping that it will be the long-awaited catalyst for domestic recovery as far as the South African growth story goes. Thank you so much for joining me for this morning session. I hope that you found the content informative and useful. We appreciate you spending some time with us, and we look forward to seeing you next time. Take care and be well. Cheers.